The market isn't rising, it's being chemically held up, and that's the contradiction nobody wants to touch, because the headlines keep selling growth while the underlying economy keeps showing strain. What you're watching isn't a healthy expansion, it's a valuation hallucination powered by continuous hits of financial dopamine. One of the clearest warning signals is brutally simple: the market cap of US stocks versus GDP. It has now pushed past 200%. Historically, once that ratio crosses 100%, a bubble starts forming. Above 150%, cracks begin. At 200%, you're no longer standing on solid ground. You're standing on thin ice. And it gets worse. The CAPE ratio, the cycle-adjusted PE, shows US stocks priced roughly 110% above the long-term average. That means investors are paying double for the same underlying value. It's like spending 100 million for something worth 50. But here's the part nobody is saying out loud. This entire structure depends on one assumption, that the Federal Reserve will always show up to save the market. Except real-world signals are flashing the opposite message. Major retailers have been cutting forecasts, consumers are tightening spending, costs are rising, and the gap between market fantasy and economic reality is widening by the week. Now watch how fast this escalates. Because when liquidity gets shocked, this doesn't unwind slowly. It snaps. America isn't drowning in debt, it's trapped inside it. Because the debt isn't just large, it's mathematically self-feeding. US public debt has pushed past $37 trillion, and the interest bill alone has surged beyond $1.2 trillion per year, more than the entire defense budget and more than half of federal revenue. That's the moment the story changes. When your interest costs become bigger than your security costs, you're no longer managing a government. You're managing a debt machine. And the machine has one rule: borrow more to pay for what you already borrowed. The trap tightens because high rates don't just fight inflation. High rates also inflate the interest burden. So the government borrows again, refinances again, rolls the debt forward again, and every cycle becomes more expensive than the last. But here's what people miss. This isn't a normal household problem. It's a global system problem, because the world has treated US debt like the cleanest place to park money. Now notice what's missing. There's no off switch here. There's no simple moment where you cut spending and the pain ends. If confidence weakens even slightly, borrowing costs rise. And if borrowing costs rise, the system gets pushed toward the one thing it always reaches for when the math breaks: printing. This is where the story flips. Inflation isn't an accident, it's a feature, because the United States has spent decades doing something no other country can do at this scale, exporting its inflation to the rest of the planet. Look at the mechanism. When the US expands the money supply, the impact doesn't stay contained inside America. The excess dollars spill into global trade, global reserves, global markets, and in the most extreme recent example, USM2 expanded by roughly 40% in just 2 years from 2020 to 22. That is a monetary shock, but the damage arrives in slow motion. Prices rise, assets inflate, real wages lag, and the invisible tax gets charged to anyone holding dollars anywhere in the world. This is where the story becomes darker, because this exported inflation model means America can trade paper claims for real resources: labor, commodities, goods, energy. It's a system where the rest of the world absorbs the dilution until it stops absorbing it. Here's why that detail changes everything. Inflation in the US peaked around 8% in 2022, the highest in 40 years, forcing rate hikes and tightening, and that creates a trap. If the US keeps tightening, debt service becomes unbearable. If it loosens, inflation returns. So the question isn't will inflation happen? The question is whether the world keeps accepting the dollars that cause it. Because once the world refuses, the inflation comes home. The dollar didn't become king because it was perfect. It became king because it was engineered. Back in 1944, the Bretton Woods system tied the dollar to gold, turning it into the anchor currency of the post-war world. But the pivot came in 1971 when the gold link was cut and the dollar became pure fiat, backed by confidence alone. That should have been the end. Instead, something else replaced gold: oil. This is where the story stops sounding like economics and starts sounding like architecture. A system was built to ensure global demand for dollars through energy. If the world needed oil, it needed dollars. If it needed dollars, it needed US financial rails. And for decades, that worked. But the long-term pattern is brutal. No monetary empire lasts forever. The British pound ruled, and then it weakened after World War II as the empire lost economic dominance and physical capacity. Here's the uncomfortable parallel. The US is no longer the factory of the world. Production has shifted east. Real goods, real supply chains, real industrial capacity are increasingly outside America. Now watch how fast this escalates, because a reserve currency can survive on trust, but it cannot survive forever without a base of real production. And once the world senses the base is shifting, it starts looking for an exit. This is where the world stops trusting the rules. Not because the rules changed, but because the rules were weaponized. In 2022, the United States froze more than $300 billion of Russia's foreign reserves. And that single move delivered a message every finance minister on earth understood instantly: your assets are safe until they aren't. Now notice what they didn't deny. Nobody denied that this shattered the idea of neutral reserve currency, because a reserve currency is supposed to be the one thing that doesn't get politically confiscated. But once that line is crossed, a chain reaction starts. Countries begin reducing exposure, quietly, strategically, not with speeches, through portfolios. China reduced its US Treasury holdings from over $1.3 trillion to around $770 billion, its lowest level in 15 years. At the same time, alternatives accelerate. Payment systems that bypass US control start expanding. Networks outside SWIFT get built. Trade routes get redesigned. This is where the story flips. Because weaponizing the dollar doesn't just punish enemies, it terrifies everyone else. And once the world starts treating US financial assets as a geopolitical risk, the dollar loses its most valuable feature: automatic trust. So the question becomes, what replaces automatic trust when fear enters the system? And that's where BRICS enters the frame. Because BRICS isn't just a political acronym anymore. It's becoming infrastructure. With expanded members like Saudi Arabia, Iran, and the UAE, BRICS is now positioned as a massive economic bloc. In purchasing power terms, it represents more than 40% of global output, enough mass to challenge the Western-led system. But the real threat isn't a single new currency. The threat is that BRICS controls the physical levers: energy producers, industrial manufacturing, raw materials, labor scale. If those assets begin trading outside the dollar, the demand engine under the dollar starts weakening. This is where the story flips again. Because global finance doesn't move on ideology, it moves on necessity. If major trade partners can settle in local currencies, yuan, ruble, or a resource-backed mechanism, the need to hoard dollars shrinks. And once that need shrinks, US deficits become harder to finance. That's the trap nobody wants to name, because America's entire modern model depends on cheap borrowing funded by global demand for its debt. So if BRICS reduces the world's need for dollars, it doesn't just shift trade, it shifts who pays for America's lifestyle. And if the world stops paying, the bill comes due inside the US. This is why central banks are moving like something big is coming, not in press conferences, in silence. Over the last 4 years, central banks have been buying gold at record speed, more than 1,000 tons per year. and the leaders include China and Russia. That isn't a trade, that's an evacuation plan. Gold isn't popular because it's modern. It's popular because it's neutral. It has no counterparty risk. It can't be printed. It can't be frozen with a keystroke. It's the one asset that doesn't care who wins an election. And here's the unsettling detail. Some analysts have floated a scenario where gold gets repriced dramatically, $10,000 to $20,000 per ounce, to rebalance debt and reset balance sheets. Now watch what that implies. If gold reprices upward, it's not because gold magically became valuable, it's because paper lost credibility. And in that kind of world, the winners aren't the people holding digital promises. The winners are the ones holding assets that don't need permission to exist. This is the kind of shift that doesn't look like news. It looks like a quiet transfer of protection. And once protection becomes the priority, the next phase starts moving faster. Because now the private sector is doing something even more revealing. It's switching currencies by choice. Major Chinese tech giants like Tencent and Baidu have begun stepping away from borrowing in US dollars and moving toward issuing bonds in Chinese yuan, known as panda bonds. And the scale is not small. Offshore yuan bond issuance reportedly tripled from 2021 to 2024, reaching nearly $200 billion. This is where the story turns surgical, because these aren't politicians making speeches. These are corporations optimizing risk. They see two things: the cost of capital and the direction of the future. Yuan borrowing costs can be around 2.1% versus 4 to 5% in dollars. So they refinance into cheaper funding, and they reduce exposure to the risk of a declining dollar. Now notice what's missing. There's no dramatic announcement that says we don't trust the dollar. Instead, there's action. That's always the real signal. And it goes further. The material suggests that foreign flows into Chinese bonds and equities began turning positive again from 2025 after a period of pullback. If that trend continues, it means global capital is repositioning, not emotionally, structurally. And once structural repositioning begins, the dollar doesn't collapse in one day. It gets drained one decision at a time. Now zoom back inside the United States, because the fracture isn't only external, it's internal. At least 7 US states have passed laws allowing gold and silver as legal tender. Think about what that means. This isn't a protest sign. This is a legal signal, a local level hedge against the federal currency losing purchasing power. Now watch how fast this escalates, because when regions inside the same country start seeking alternative money, that's not normal financial behavior. That's defensive behavior. And it's happening alongside political paralysis, debt ceiling fights, fiscal deadlocks, budget chaos. The mechanics of governing start turning into a power struggle instead of a solution engine. This creates a feedback loop. The more unstable politics become, the more global lenders question long-term stability. The more global lenders hesitate, the more expensive borrowing becomes. The more expensive borrowing becomes, the more pressure builds to print, and when printing becomes the easy choice, the long-term consequences get pushed onto ordinary people. This is where the human cost returns, because inflation doesn't just change prices, it changes behavior. And once behavior changes, the system stops working the way it used to. Now we reach the pillar that holds everything up, the petrodollar. For 50 years, petrodollar dynamics created forced demand for dollars through energy trade. Oil exporters accumulated dollars and recycled those dollars into US Treasuries, helping fund American deficits at lower rates. But now the pillar is cracking. Saudi Arabia, the cornerstone of that system, has openly discussed selling oil in yuan and has moved toward BRICS alignment. This isn't symbolic, it's structural, because if oil can be sold outside the dollar, then energy no longer forces global demand for dollars. And if global demand falls, the Treasury market loses one of its most reliable sources of recycled capital. Here's why that detail changes everything. If oil exporters no longer need to recycle dollars into treasuries, the US has to attract buyers in other ways. Higher yields. Higher yields mean higher interest costs. Higher interest costs push the government deeper into the debt spiral. And once that spiral tightens, the Federal Reserve faces the same brutal choice every declining monetary empire faces: defend the currency and break the state, or support the state and break the currency. So the story ends where it began. The market isn't rising because it's healthy. The system isn't stable because it's safe. It's stable because it's being held together. And the moment the holding mechanism weakens, reality doesn't drift back in gently. It slams in. If you want the next layer, what a controlled reset could look like, how digital money could become the new enforcement tool, and what signals appear right before the reprice, make sure you subscribe, because the next move isn't a crash, it's a transition, and it's already in motion.